So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I am joined today by Jeff Greenburg. Jeff is CEO of Synergetic Investment Group. For the past 12 years, he has managed all aspects of commercial real estate ownership, including acquisitions, operations, value add, dispositions, and investor relations. SIG currently focuses on using a deal segregated private equity fund, which helps high net worth individuals passively invest with best-in-class commercial deal syndicators and invest in commercial real estate and other opportunities. Jeff, welcome to the show.
Thank you very much. I'm glad to be here.
Awesome. So we've obviously connected through Raise Masters, met a few times. Shout out to Hunter and Adam. It's an incredible group. But let's kind of start at the very beginning. Have you been in real estate kind of since the start of your career, or what led you here?
I started out in real estate itself in about 2005. Didn't really get into commercial real estate until about 2008. When I realized that my funds weren't going to last very long, that commercial real estate, I was able to bring in other people's money and leverage my funds as well.
Awesome. Yeah, pretty common transition there, kind of the scalability of things. So obviously we were kind of talking offline, you're getting almost to exiting all of your operational duties. So kind of talk about that progression. You start as an operator and now focusing strictly on capital raising. Kind of talk about that. What led to that decision?
Yeah, as I said, I've been an operator for the past 12 years, and there's a lot of different job responsibilities I've held. I mean, I've held every one of them, including, broker relationships and finding deals and underwriting deals and all of that. And I came to the realization that there was a lot of stuff that I was doing that I didn't enjoy. And I did have partners on different aspects and different deals over the years. But what I realized was that I liked the idea of investor relations more than anything else. I didn't really care for the operation side of it and didn't feel I was a great operator. I guess when I brought on an asset manager in one of my last properties and realized that she was doing so much better of a job than what I would have done if I was the asset manager, I realized I wanted to hook up with great asset managers, great operators, and let them do their thing. And I could just help take care of investors. And there's such a need out there that I decided that was the direction I was going to go.
I love that. And that's kind of the philosophy that I've taken on as well. You really get to leverage, like you said, best-in-class operators, allows you to be nimble in terms of which markets you want to get into and asset classes. So we were talking offline. I know, you're raising for kind of a unique asset class in terms of, it's not related to real estate. So let's kind of get into that, which is a Bitcoin mining. So kind of talk about, how that came to be.
Yeah, one of the issues that I'm finding is finding good deals right now that are not that people haven't overpriced, or the underwriting isn't as conservative as I would like. And because of that, I've gotten into a couple of deals, but there's other deals that I just have walked away from. So while I'm looking for good quality multifamily, self-storage, mobile home parks, and assisted living, which I still like as asset types, I came on this Bitcoin mining, which one of the things I really got excited about on the Bitcoin mining, and not just the immediate cash flow of it but the downside protection, because I think a lot of us are thinking about, okay, what's going to happen? We've got inflation that we know we're dealing with. We may end up in a recession. How does this other asset class protect us in case things aren't going the way that we want? And the Bitcoin mining excited me about the protection on the downside. And so I looked into it farther and found out that not only does it have great downside protection, but it's got some great potential for upside. Also, you can, the way this is being set up, you get all your capital back within 18 months. And so now your capital is back. Everything else that you're making is profit. So for the next 3.5 years after that 18 months, you're going to be making profit, and possibly beyond that, depending on the ability of the machines to still cost effectively produce. But that's all bonus on top of everything else. And the returns are phenomenal, and they're monthly cash flows.
Awesome. Yeah, I mean, makes perfect sense. And if I understand correctly, there also is a bonus depreciation as well, yes?
Yes, absolutely. First year, you get about 90% depreciation, as you would in real estate. And the main reason for that is the fund, the main expense of the fund is going to be the purchase of the miners, which are essentially computers, specialized computers. And so you get to write off equipment over a 5-year schedule, except with bonus depreciation, you could do it all in year one. And so 90% of the expenses are going to be written off on year one, which is great. So if anybody needs passive losses, you get to write that off year one.
That's awesome. And what a great opportunity. So let's kind of switch here to kind of the investor level of this. We were talking offline. You said you didn't really do much in terms of, gauging interest. You just kind of presented it, and you've, been successful. But one thing that you have is you use a vestor, which is kind of an open fund with different opportunities inside of that. So kind of talk about, your decision to go that route, and how that's worked so far.
Yeah, this is a fairly unique platform. They've got a portal, but they also have the software that will allow you to create a fund. And first, a deal segregated fund, but one of the disadvantages typically to a normal fund is whatever deals are brought into the fund, you're in those deals, like it or not. So you are relying very heavily on the fund manager to pick and choose deals that are appropriate. And the nice thing about the deal segregated fund is you can decide when a deal comes in, you can decide whether or not you want to be in that deal. You don't have to be in that deal. You don't have to be in every deal. You could be in as many deals or as few deals as you want to. It will all be calculated through the software as far as your shares and your returns and all that. And then at the end of the year, you'll be given 1K1 for the entire fund. And so you could be in 10 different deals and only get 1K1, all of them accumulated for you.
Wow. That's awesome. What a great platform that they've made available. And I met with them as well. And it's really a great opportunity. Obviously, huge bonus there with the aggregated K1, because I know, especially this time of year, that's probably the biggest concern that your investors have.
Absolutely.
What's that?
Getting the K1, getting the CPA to get it done and get it out. And yeah, and the investors are always, looking for those K1s.
Absolutely. So let's kind of talk about, obviously you've built up your investor base over, a long career. What are some of the things you're doing now? Are you implementing the RaiseMaster system and keeping them engaged, and kind of, how you're able to be so nimble and move between asset classes and keep your investors along with you?
Yeah, well, that's one of the reasons that I went to RaiseMasters is I've been doing all the different aspects, for these years. But most of my contact with my investors has been one-on-one contacts, either meetups, going to boot camps, going to conferences. That's where I've met most of the people on my list. I've also been on a lot of podcasts, so that also has gotten a lot of investors to know me and finally to get relationships with them. But I'm looking to expand on that, and that's where the Raise Masters has come in, where I'm looking at doing more digital stuff, getting on podcasts, having different educational materials available for investors, and so they can get to know me and understand me as well as the business. I like education. I like educating people and teaching them about the business. So I get to do the fun part now, the part that I really enjoy, which is educating people and helping people make money. If I can make money alongside of other people and we all make money, I mean, it's all a win-win situation.
Absolutely. It's so true. And, the Raise Master system is pretty much all I've built mine on, but you obviously, had some other systems in place. So do you have partners as well in this, or is it just you at this point?
Pretty much me on this point.
Nice. That's awesome. So that probably feels really good to kind of just be on your own and build those relationships. So do you still focus on the one-on-one, or are you really just more on the digital side of things?
I do both. I mean, I still run a couple meetups and I'll still go to conferences and meet people because I enjoy that part. Last time the conference I went to, the Best Ever conference, I spent more time in the hallway than I did in the meetings. So now I've just got a link to the recordings. I could listen to all the events, all the conferences that I missed, because I spent most of the time. I hadn't seen people in years because of COVID. So I was able to catch up with a lot of old friends, talk to people about deals, talk to people that are thinking of investing. So it was a great time, having those one-on-one time with people.
Absolutely. Yeah. Best Ever was really awesome. I know it was for a lot of people, their first, in person since COVID, which was, great to hear people finally, coming out and getting to meet one-on-one. It's always funny when you've connected over Zoom and LinkedIn, and then you finally get to meet people in person. You're like, I actually know you.
Yeah. I mean, it certainly is nice to be able to sit down and have a meal with somebody. You gain a much better relationship with people, as far as really getting the good feel about the person. And this is a people business. And I do believe when I'm invested with deal sponsors, people ask me, what do you want to find out about the deal sponsor? So I really want to get to know them. I want to know them as a person. I want to know what motivates them, as well as I want to know who's operating the deal, who's looking over the deal, who's making sure that the plan gets taken care of. But it comes back to the people. And then I'll look at the numbers and I'll look at the deal. But I trust the numbers a lot better when I trust the people putting those numbers together.
Absolutely, because you can make a pro forma look anywhere you want. And so it's really about trusting that operator. So let's kind of touch on some of that stuff. Obviously, you kind of alluded that deal flow, or at least deals that you like, kind of lacking right now. Obviously, the market's kind of going crazy. So talk about some of the things you look for, like kind of your due diligence for operators, and then, what your ideal deals look like.
Well, I'm look for an operator that's been in business for a while. I want to know, their background as far as being an asset manager. I want to know somebody that pays great attention to detail on the KPIs, the key principal indicators, that they're making sure that things are performing. Looking over the variances every month, knowing, what's the reason why the budget was up or down, whatever that may be. And just, doing a lot of detailed stuff, which is the part that I didn't like doing. But I want to know that the people are doing that. When it comes to the underwriting, I want to see what their assumptions are. I want to see their assumptions as far as, what they expect the rents to be, how quickly they're going to be able to get those rents up, what they expect the occupancy to be, to see if I agree with them, to see if I think those are realistic. And a lot of times I see very unrealistic ones. The other thing I like to look at, and I mentioned it earlier about, I'm concerned about downside protection. I want to know what they're doing to protect the downside. How long is the loan? What happens if they've got a 3-1-1 loan? Okay. Do they have enough funds in reserve if for some reason they have to hold out for a while? If they have the occupancy is down, what's break even occupancy? Just looking at overall, what if their plan doesn't work and things aren't going as well? I mean, I'm fine with looking at something that says, okay, on the downside, we may break even and not make very much money in returns. I've done that before. I've had deals like that, but I don't like looking at the downside as losing a property. So I want to make sure that they have enough funds in reserve to keep the property functioning if something does happen, for maybe a 6-month period or so, and what kind of lending they have on it.
Makes perfect sense. And are you also basically verifying the underwriting and doing your own underwriting and stress testing as well? Or once you trust the operator, are you kind of trusting their underwriting?
I always do my own underwriting, or I'll send it out to have somebody else look at it as well. I have found that, even some operators that I thought were very good, and then I've looked at the stuff and I've sit there, I don't see how you're going to get there, or you're pushing it. And there's groups that have gotten 6,000. There was a group I was looking at, 6,000 doors, and they had some questionable stuff in there that I said, how, maybe they've only been involved in a bull market. That's why, hey, everything's looked rosy now. I mean, there are geniuses out there right now. Everybody's a genius, no matter how poorly they bought the property, they're geniuses because the market is making them geniuses. My question is, what happens when the market changes and they're no longer geniuses? Are they still protected?
Yeah, and you kind of nailed that right on the head, right? We're all hitting home runs right now, and everybody looks like an all-star. So kind of talk about some of the economic indicators that you're really paying attention to, and some of the things you may be concerned about with some of these operators and kind of their approach.
Well, I mean, there's tons of things that I've seen. There was one, somebody was asking me to look over a deal because she was going to raise money for an operator. And I looked at the first cell, where it says, the year one income, and they had it increasing somewhere around 600,000 from the T12. And I'm sitting there, what the hell? How are they going to do that? And I was trying to figure out how the hell they could do that. I mean, they're talking about increasing rents. They're talking about increasing occupancy, meanwhile, not losing any occupancy. And I'm sitting here, and they're looking at renovating 100% of the units. And I'm sitting there, well, wait a minute, or 50% of the units, but I'm sitting there still with that. In year one, you're going to be able to pull all that off. That just wasn't going to happen. I saw another one where a guy had, it was going to be a fund from the lender of $6 million for his CapEx. Okay. At a CapEx budget, $6 million, lender was going to, that's going to be part of the loan. And for the first 3 years, he zeroed out repairs and maintenance. And I'm sitting there, what? I don't care what you're doing with CapEx, you're still going to have repairs and maintenance. And so any money we need, we'll just get it out of the CapEx. And for anybody that's tried to get your money back from the lender, what a pain in the butt that is. And you've got to show them invoices. You've got to, plead with them to get it back. And some lenders only will give it back to you quarterly. So you're waiting for that money. Well, that just doesn't work if you're relying on that, for your repairs and maintenance. Not only that, they're not going to give you money back for unplugging sinks or replacing fixtures or fixing an AC unit. You're not going to, or patching a roof or whatever. You're not getting CapEx money for that. So I just walked away from that, and I know somebody that's raising money for that deal, and I couldn't do it. I couldn't, in good conscience, raise money for something like that.
Yeah, that's a really good point that you bring up. It feels like a lot of operators are really just almost doing anything they can to make the deals work. And obviously it's tough right now, right? Like interest rates are on the move, materials, there's so many variables at play right now, but they're still there, right? Finding the good deals. So once you've established a good operator, do you typically follow them if they're moving markets as well, or do you kind of just stick to some main markets?
Well, right now I've got one operator. I'll follow her anywhere. Right now she's in Houston, but I like her underwriting. Her underwriting is solid. Her asset manager, she was my asset management. She was my asset manager on my Amarillo deal. And I'm looking at any deals that she does because I know how she underwrites. I know how she operates. And I know how she works in sticky situations because we definitely had some of that. So someone like that, yeah, I'd follow her just about anywhere. I'm still looking for others. I'm still looking for some others. But if I find somebody I'm really feeling good about and I like the way, then I probably would follow them to different markets. I would have to evaluate those markets, but yeah, I'm open to different markets.
Are most operators open to kind of the fund model or SPVs that you found?
Some are, and that's the dilemma that we have as fund managers, is some of the real good quality operators don't need us because they can raise money all on their own, no problem. And then you have the ones in the middle that are good operators. They're a little more up and coming, and they could use a million, couple million. If you come in with enough, I had one operator told me, if you can come in with 2 million, then we'll take you, but 1 million is too small for them. So there are some operators out there, and a lot of them will set up their deals automatically to accommodate it on the LP side. So they may come in with a class of LP investors that if you bring in $1 million, we'll give you these terms. If you come in with under 1 million or under 250,000, you have these other terms. So the better terms allows us to use that delta and give our investors the same that they would get, the same or better. I'm in a deal now where we're projecting we're going to get our investors better than if they were able to go straight into the deal. And we still get paid as well. But I'm able to use those terms that we either well, in this particular case, I negotiated, or if they're automatically there. If there's enough meat on the bone there, we could get our expenses taken care of and do better for our investors.
Awesome. I love that. It's so true. And that's why this is such a great skill to have, because you do have that opportunity to negotiate potentially and get better terms for your investors than if they went straight to the deal. But on the operator side, is there anything different in terms of the structure that they have to do in order to bring on a fund as an LP, or is it just exactly how it always has been?
Well, if they're coming, let's go back to the ones that the ones that bring people in on the GP side. There's a lot of people that bring a lot of people into the GP side, and their main responsibility is raising capital, which is not compliant with the SEC. And they also have to do other responsibilities in order to become compliant, but they're not supposed to be compensated based on how much they raised. So the LP side is a much easier way to be compliant. Now, Some deal sponsors do it right away where they just have a separate class. And the class may be $1 million, it may be 500,000, it may be $2 million as the hurdle that you have to get past to come in on the LP side. So some sponsors are doing that automatically, because that way they open up the door for fund managers to come in. I know one self-storage company that if you bring in $1 million, they give you a 20% increase in shares. Now that 20% that's extra above and beyond the normal shares, goes into the fund, and the fund manager can do what they want with it.
Wow. Interesting. So it really just kind of depends on the operator and if they're set up for that. And, like you said, a lot of the top ones are doing everything in-house and don't really need that. But there are also some, best in class operators that are very fund friendly. I know there's some in Phoenix that, incentivize and kind of do the two classes of shares. So when you are structuring your deals, are you able to do two classes of shares even if the operator doesn't have it, or what does that structure look like? Do you just kind of follow what they have already?
Well, the main thing is to get to them before they've really finished up their PPM. And that way they can put it in and don't have to go back and try to redo it. So far, that's what I've been able to do, is to get in early. So the thing is to get with the deal sponsors way before they have deals. So I do the vetting and getting to know them way before the deal comes around, and let them know what I'm looking for. And if they're willing to work with me. If they're not willing to come up with separate classes or don't want to work with that, then I probably not going to be able to do deals with them.
Okay. That makes perfect sense. So really just about getting in there early and kind of establishing that, which is really a key, right? Because then that's how you can raise more money, is having those two classes of shares. And do you find that investors are typically willing to bump up to that second class of shares to get the extra either hurdle or pref or whatever it is?
Well, the investors don't have to do that, because the investors could come in with the same minimum as the
Right.
fund. It's the fund coming in. So the fund, if the fund comes in with $1 million or 2 million, I mean, we're accumulated that from, might be 50K investors. My investors could be anywhere from 50K to 250 to 500, but my fund will come in at over $1 million. And so we get the benefits of that.
Got it. Okay. Awesome. I like that a lot. So unfortunately, we are up against time here. So we're going to jump into the final 5 questions, which are the same 5 questions I ask all of my guests. So the first question is, what's the best advice you've gotten from a mentor?
Best advice I've gotten from a mentor is to find a mentor. I would say, finding somebody that's doing what you want to be doing and finding a way to be a resource to them. Find something that you could do to help somebody out. I mean, I'm not saying you have to have a paid mentor, even though I've had many paid mentors, but in the beginning, and you may not have money, but find a way to be a resource to somebody else that's doing what you want, and get involved that way, build your credibility, and start getting your resume built up.
I love that. So true. That's such a great point. What is it about your career that makes you feel like you're fulfilling your why?
Well, my why was for the financial freedom for myself, but it also was raising money for, or financial freedom for my kids and grandkids. So at this point, I've essentially gotten my financial freedom, but I still want to get involved with my kids and grandkids. So that's why I'm still in the business, still putting money away for them, and also trying to educate them. I'm leading by example, showing them what I'm doing. And I had a couple deals where I was putting my grandkids' money, or I was putting money in for my grandkids and buying them shares of the property. And then we just sold those properties. So now they could see their bank account is growing. from the properties we just sold.
Awesome. I love that. That's incredible that you have that opportunity and are able to do that. What's your favorite non-real estate or investment related book?
Non-real estate or investment related. God, everything I read is real estate or investment related or of some kind of, I mean, the last one I read was the story, what is it? Story Brand.
Yeah, that's a good one. Read that one as well.
I like that, but that's certainly business related. I mean, unless it was a Tom Clancy book, I haven't read too much in a while.
Nice. Love it. Tom Clancy's great. Love some of his books.
Yeah.
If you could have any superpower, what would it be?
Photographic memory.
Nice. That would be awesome. That would be awesome. I love that. And last one, what's the best way for people to get a hold of you and learn more?
You could get a hold of me at my website or Jeff at synergetic.ig.com, and that's synergetic.ig.com. You could always email me, set up an appointment, be happy to talk to you. Always enjoy educating new people and helping them out. I believe in paying it forward, and that's what I've been doing all these years, and that's why I've been successful.
I love that. We will link that in the show notes. Jeff, thank you so much. This was awesome.
Thank you for having me.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.